Hi, I'm Cary Artac, founder and chief analyst of Artac Advisory. Today's video, taped on Monday, May 18, 2015, addresses the mid to longer term technical dynamics that are currently playing out in both crude oil and the US dollar. With international crude oil pricing pegged in US dollars, there's inherently a rough inverse price relationship between the two markets. I'll be referring to the West Texas Intermediate Futures contract, commonly known as New York crude oil, with the US dollar represented by the US dollar index, which expresses the value of the US dollar relative to a basket of prominent foreign currencies, including the euro currency, the Japanese yen, British pound, Canadian dollar, Swiss franc, and Swedish krona. I'll be using the underlying cash index, though a US dollar index futures derivative is actively traded on the Intercontinental Exchange. When analyzing any market, I generally like to start with longer-term analysis and gradually work my way into the nearer-term outlook. Besides channel formations and a range of Fibonacci studies, to name a few, one of the tools I've used for many years are the 1/3 and 2/3 speedlines. They are trend-defining studies and are essentially trend lines constructed by using both the 1/3 and 2/3 retracement levels. For instance, in this monthly US dollar index chart, you can see that over the last 30 years, the price extremes have been the 1985 high and the 2008 low. The 1/3 or 33% upward retracement off the 2008 low is found at 102 even. By projecting a descending trend line from the 1985 high through the 33% retracement where it intersects in time with the 2008 low will convey a long-term descending 1/3 speed line. In September 2014, the US dollar settled above this indicator, thereby signaling an end of the preceding 6 years of consolidation, and with that a long-term upside target at the 2/3 speed line, currently at 123.56 for the month of May 2015. We're talking big picture here, years, not months, possibly 3 to 5 years, though a reminder that currency markets have an interesting way of accelerating time horizon objectives in a very dramatic fashion. Now shifting to crude oil, let's back up to the 2008 low, when, following the banking financial crisis of that year, the market bottomed out at a 10-year trend line projected off the 98 and 2001 lows. A 2.5-year recovery ensued before the market steadily consolidated over the next several years into a wedge pattern that culminated in the summer of 2014, when a monthly settlement last August below a 6-year ascending 2/3 speed line indicated a weak market. That long-term trend line once again managing to absorb the brunt of the late 2014 sell-off, though in less than perfect fashion. Over the last 30 years, the inverse correlation between crude oil and the US dollar has not been an entirely direct relationship, though in the last 6 to 9 months, it's been unusually tight, meaning a longer-term signal over the next month or two in one market should elicit its opposite in the other market. How might this play out? I'm glad you asked. Once again, speedline analysis can provide an effective indication. With regard to the US dollar index, the more recent chart extremes are the 2008 low at 70.69 and the March 2015 high of 100.39. The ascending 1/3 speed line, currently at 90.97 for the month of May, can contain selling through the balance of the year, above which a bullish dynamic continues into 2016. That 123.56 target I mentioned earlier remaining a technical reality into later decade. On the other hand, an end of May settlement below the 90.97 speed line, which rises to 91.21 for the month of June, would indicate a good 2015 high. The US dollar then expected to break back into the lower 80s over the following 5 to 8 months. Using the same methods in New York crude oil, we can construct a more recent descending 1/3 speed line off the 2011 high against the recent 2015 low, coming in at 64.16 for the month of May, dropping to 63.10 for the month of June. This indicator is capable of containing strength through the balance of 2015, below which a retest, if not outright violation, of that 17-year trend line is expected within several months. On the other hand, an end of May settlement above this 64.16 speed line would indicate a good 2015 low, then signaling recovery over the following 5 to 8 months into the upper 80s. A reminder that the scenarios I just outlined, which define a potential buy signal in crude oil and sell signal in the dollar, have yet to materialize. They only outline my trigger points for longer-term trend reversal. The old trading adage, "the trend is your friend," certainly applies here, And in my view, the trend into later 2015 for crude oil remains heavy below the 64.16 speed line, and in the US dollar index, bullish above 90.97. These levels changing on a monthly basis. I'll likely update this outlook into later June, so please stay tuned for future videos. I hope you found this analysis helpful. I'm Cary Artac, and thanks for watching.